Hi, I'm Cal, founder of Option Trading for Rookies. You can find me on tastytrade.com, the largest online financial network in the world, as one of its first rising stars. Now listen, nobody cares about your money more than you do. But because we don't understand the stock market and options, and how to trade options correctly, we all end up giving, for the most part, our money to some professional financial advisor, and then we just watch it go up and down year after year, pretty much going nowhere. We're all very busy people. So who's got the time and energy to learn this complicated stuff? Well, good news. I've taken the time and I've spent the energy over the last 5 years, and during my journey I've learned 3 very important things. Number 1, trading is not as complicated as professionals would lead you to believe. In fact, it's pretty easy. Number 2, trading does not take a lot of time. You can do it in less than 15 minutes a day. And number 3, trading does not take years to learn. In fact, I can teach you everything you need to know to become a successful trader in just these few courses. In this course alone, I'm going to teach you what options are, how they work, why options are actually safer than stock calls and puts, and how to trade them, buying options versus selling options, and so much more. Not only am passionate about teaching people how to trade successfully, I use this exact same information every single day in the stock market to get financial returns that beat 95% of the managed funds out there. And I do it in only 15 minutes a day, and I do it with a full-time job. Now, it's important to tell you here that you do not need to know anything about fundamental analysis for my program. You do not need to spend any time researching companies. You also don't need to know technical analysis. My program is based strictly on strategy, and strategy can be applied to any stock at any time. As I said before, trading is not as hard as people want you to believe. All you really need to know how to do is add, subtract, and do percentages, and good news. If you don't know how to do that, the calculator on your phone will do it all for you. In this one course, I'm going to take you from absolute ground zero, starting with what is an option, all the way to the point of complete confidence in trading. So join me and let's get started.
Before we proceed, please take a moment to read the rest disclaimer, and once you're done with that, let's get started.
Before we get started, I think it's important to let you know, because you can see a lot of visuals. People always ask me what software I use to trade now, just like every other software out there. It's constantly updated, it's getting bought, it's changing names, etc. So in my case, for most of the presentations I use Do software as a platform, but unfortunately that software does not exist anymore. It has morphed into Tastyworks, and who knows how long Tastyworks will be around. But for the most part, Do Tastyworks software will be what I'll be using in most of my presentations. Also, Think or Swim by TD Ameritrade is also a platform I use in a lot of my slides as well. Now you can use any software you like. In many of my examples you'll see certain things like volatility rank or whatever you need to be able to use in order to trade. You're going to want to find out if that software has that available, because not every software has every possible thing available to it. So like I said, these are the things I use for now. They will change over time or morph into something else. But it's up to you to look into what you need to do and make sure before you sign up with a certain trading software or a certain trading brokerage house that the software can handle what you need to handle. And we start by saying, what is an option? And you see here, I see driving the car in parentheses. And what do I mean by driving the car? Well, here's a car, and here's all the parts that go into building your car. Now, do we need to know how all these parts go together and how they all work in order to be able to drive the car? We don't, and that's the exact same analogy we're going to use to learn to trade options. We don't care about all the behind the scenes of the options, the computers, the algorithms, how it all works. Not important. All we need to know is how to drive this car, and we start by defining an option. So what is that option? Well, actually, an option is just a contract between two parties. Okay, there's a buyer for an option and there's a seller of an option, and we can take either side of this trade. We can be a buyer or a seller. Do not worry about what this all means. Like I said, I just want you to understand this. Parrot fashion, merely definitions. We will obviously go into more detail as we move forward with this program. So again, an option. It's just a contract between two parties. There's a buyer for an option and there is a seller an option, and you can take either side. So what does it mean when we take a side of an option? Well, whether a buyer or seller, what that means is one person is betting the stock price is going up, and one person, when they make this contract, is betting the stock price is going down. Option characteristics defined. Here's the 5 characteristics of an option. 1 option equals 100 shares of stock. They expire on the third Friday of the month in which your option is in. There are multiple time frames, as in months. There's multiple what they call strike prices, and there's something called the bid-ask spread. We're going to go through each one of these individually. Don't be scared yet. Remember, again, we're not here to understand this yet. We're just here to define it. So I want you to learn this parrot fashion. So let's start with an option equals 100 shares. Well, in order to understand what that means, we need to know what a share is. So you've probably heard the term stock, maybe, or shares. Really, what that means is we're actually buying a piece of the company. So to put it in easy terms, if a company only had 100 shares of stock and we bought 1 share of that company, we would literally own 1% of that company. 1 share out of 100, we'd own 1%. In the case of options, these are actually something called a leveraged product. So 1 option actually equals 100 shares of stock. Again, just definitions, don't worry about understanding. And finally, there's certain terminology we use when we're talking about buying stock. You might hear buying stock, you might hear something buying shares. They're synonymous. Generally, what we say is we're buying 100 shares of stock. So let's get back to this. 1 option equals 100 shares. What does that actually mean? So let's look at this. I'm using up here Priceline as our stock, and you'll see why in a second. And here is the last price that Priceline traded at, $1,174.17. So in this case, if we are going to buy 1 share of Priceline stock, this what it would cost us. We're buying 1 share of Priceline stock, and you can see over here it'll cost us $1,174.17. That's a lot of money for 1 share of stock. Understandably. Okay, so remember though, an option equals 100 shares of stock. So in the case of Priceline, what it actually looks like is this, because an option equals 100 shares of stock. This is kind of what we're talking about. 1 option actually controls this much Priceline stock. I know it's a lot of money. 1 option actually controls 100. Controlling $117,417, $117,000 roughly of Priceline stock. That's all that means, 1 option. When I say 1 option equals 100 shares of stock, you just need to know that you're controlling 100 shares of that stock with 1 option. And in the case of Priceline, I chose a big stock with a big price just to really accentuate this point. Number 2, or B, of option basics is options expire on the third Friday of the month your option is in. So as an example, if you had an October 2015 option, it would expire on October 16th, which is the third Friday in October 2015. In November, it would be the 25th, the third Friday in November. and December would be the 18th. Now it doesn't matter when you buy these options. If I buy an option on October 15th, in October it's going to expire on the 16th. If I buy a December option, and I buy way back in October but I buy December, doesn't matter whatever month my option is in, it's going to expire on the third Friday. That's all you need to know. And that's what I mean by the third Friday of the month and which option is in, because you can buy October options. November to December doesn't matter. You just need to know it's going to expire on the third Friday of the month in which your option is in. Now, when I talk about options expiring in the third Friday of the month, which option is in, I think it's important I clarify one thing, and that is when I talk about that, I mean the standard expiration cycles. So if you look at this here, this is a trade page and you see all these red letters. But when you see the ones without the red letters, like here, March 13th days, that means it's 13 days until the third Friday in March. Down here, you see again, no red letters. 48 days until the third Friday in April, etc. May. 76 days to the third Friday in May. But I think it's important for you to understand that there are different option expiration cycles. I usually stay away from them because they're not necessarily as liquid, and for other reasons, but it's important to know that they exist. So what you see here with W on this particular platform, this means weekly and this means quarterly. So these are going to expire at various points and there's no specific day of the week or days to expiration. These are going to vary depending on the certain stock you're using, etc. But I think it's important to know that there are things called weekly expiration cycles. And you see here they can expire at all different kinds of days to expiration to, for in this particular case, 6, and on the quarterlies. Obviously there wouldn't be as often they're quarterly. So you say they're going to be different option expiration cycles. But once again, I think it's important for you to understand we prefer to use monthly expiration option cycles because these are the standard ones, which are the most used ones. And so they're the most liquid, as they would, as you'll learn about. But you do need to know that there are other option expiration cycles that can expire at all times of the week, all different times of the month. And these are weeklies or quarterlies. And there's multiple time frames for options. Then when you buy stock, it's one time frame, it never expires. Okay, we buy a stock, we own it for as long as we want to own it. We can hang on to it for the next 30 years. Doesn't cost anything, we've bought it. It's ours. But options have multiple time frames. So what does that mean? Well, let's look at a different trade page because it's accentuated here, and you see there's June, there's July, August, October, January. So a couple of things that one should notice here. Here's the multiple months. Okay, that's what I mean by multiple months as far as multiple time frames. There is the thing which is valuable is this little parentheses here, which is how many days until expiration. We've just learned how options expire on the third Friday of the month in which they are in the making of this slide. What this means is it's 6 days until the third Friday in June. This is 34 days until the third Friday in July. That's all you need to know. Multiple time frames as in months, and not every month has to be there. You can see there is June, July, August, we're missing September, we're missing November. December, not important. Every option has different months available to it. But the important thing to note is that there's multiple time frames and they're going to expire on the third Friday of the month in which your option is in. And there's something called multiple strike prices. Okay. Stock has one price when we buy it. That's the price you bought it at. So we just hang on, doesn't matter. Options have what are called multiple strike prices. Just a quick definition of what a strike price is for us. All we need to know is for trading terms, what would a strike price means to us is it's the price of where we want the stock price to move up or down away from. Okay, that's it. Trading terms for us. Strike price means the price of where we want the stock price to move up or down away from. And that's going to depend on the option strategy we choose. Like I said, this is further down the line as we learn option strategies. This is purely for definition. Strike price to you at this point just means the price of where we want the stock price to either move up or down away from, and like I said, we'll learn more about strike prices later. But what are strike prices and what they look like? So let's take a look at this. I'm opening in July and you'll see here it says strike. These are strike prices. These four numbers here: 1165, 1170, 1175, 1180. Now there can be hundreds of strike prices. Okay, once again all we need to know is we want the price to move up or down or away from it. These are the strike prices, and in this case there you can see they are $5 apart, 1165 and 1170. Just to show you, I've only got 4 strike prices here. If I go all, you'll see now. Wow, look at this. Right as you scroll down you can see all the numbers here. That's all the different strike prices that Priceline has. Okay, so you can see there's multiple strike prices. I'm going to put it back to for us, it's easier to read. But that's all you need to know, is that every option chain for like every month has multiple strike prices. And then there's something called the bid-ask spread. So what's that? Once again, let's open up July options and you'll see here bid and ask, and you'll see 2 numbers here for each one under bid and ask. So what does that actually mean? Okay, well, we can consider the bid equals the sell now price and the ask equals buy it now price. And what does that mean? Okay, if you've ever used eBay, you know that there's something called the buy it now price when they're listing items for sale. Sometimes somebody says, hey, I'll list it for $5. But if you're going to pay $20 for it right now, I'll sell it to you. I won't even bother going to the auction. I'll just take it right now. I'm going to pay up for it because I want it badly. The same thing works in the auction world. So the bid means sell it now price, and you can see that price is the low price and the ask price is the high price, which seems kinda backwards, right? Because generally speaking, how do we want things to work? Well, if I'm selling something, say I'm selling my car, I'd like to sell it for the highest price possible, right? And if I'm buying something, let's say buying a car, I'd like to buy it for the lowest price possible. But in this case you see the sell it now price is the lower price and the buy it now price is the higher price. Why is that the exact same thing as the eBay scenario? If I want something so badly I'm willing to pay up for it, I'll pay more than the other guy just because I want it badly, I want it right now, and that's just ask price. Right, that's the highest price I'll sell to you right now for the $29.10 price, and vice versa. For selling, I'm in a hurry to sell this thing. I'm not looking to get the highest price for it. I want to sell it right now. So I'm gonna sell it for $27.80 right now. And that's what that means. It's just the extremes. The highest I'll buy it for and the lowest I'll sell it for. And somewhere in the middle is the perfect price. And that is this price right here. This is what we call the mid price. Okay. And the mid price, you can see if you work it out, is the exact middle price between these two numbers. If I add 65 cents to 27.80, I get $28.45, and then subtract 65 cents from $29.10, I get $28.45. So what does that mean? Well, it means neither the buyer nor the seller is being taken advantage of. Right? We're both kind of agreeing on a perfect price right in the middle. Nobody feels like they've paid too much. Nobody feels like they sold for too Little as traders, we're always looking to make our trades for the exact mid-price, and that's where we're never being taken advantage of. So bid-ask spread, the definition again. We as traders are always looking to buy or sell options for the mid-price. That's the fairest price. That's the price we want to get things done at. So here's a recap of option characteristics defined. And remember, I want you to know these like parrot fashion, don't need to understand them yet. We'll get into more detail, but these are the things you need to know. And option equals 100 shares of stock. An option expires on the third Friday of the month in which option is in. There are multiple timeframes as in months that options have. There are multiple strike prices within each month, and there's something called the bid-ask spread, and we're always looking to do something at the mid-price. Well, remember, an option is just a contract between two parties. One side's betting the stock is going up and one side's betting the stock price is going down, and the way we do that is we're a buyer of a call if we believe the stock price is going up. We're a seller of a call if we believe the stock price is going down. And as we talked about before, because it's just a contract, we can take either side of this. We can be a buyer or a seller. So let's look at that visually. So here's a trade page again. This is just one of the trading platforms I use. And what we're going to do here is we're going to look at buying a call. And if you can see here, there's a green shade and there's a red shade. What that means is as the price of the stock goes up, which in this case, remember, is price line, we make money. That's the green. Green when we make money. As the price of price line goes down, we lose money, and that's because we're buying a call, and we buy call when we believe the stock prices are going up. If we flip it to the other side and sell the call instead, and then you can see here we flip to selling the call, and what happened? Well, look at that now. As the stock price goes down, we make money, and then as the stock price goes up, we lose money. Same call. We're just selling it now instead because we believe the stock price is going down. That's how it works. Buyers, of course, believe the stock price is going up. Sellers, of course, believe the stock price is going down. Want to just cover again this contract scenario because it was confusing to me in the beginning as to buying and selling something. Remember, we can buy or sell an option, but it was really hard for me to understand how do we sell something we don't even own. Right, because I considered options kind of like buying a car, right? I couldn't sell you my car if I didn't have a car. How could I do that? So that was hard for me to grasp. So the reason we don't have the same problem with options is because options are not a tangible asset. They're not a car, they're not a tangible thing, it's just a contract. It's an agreement between two parties. Okay, it's one person's betting the stock is going up and one person is betting the stock is going down. So really it's just like making a bet with your friend. Okay, if I was betting on a football game and one of us was taking the Patriots to win and one of us was betting the Patriots would lose. That's similar to an option contract. It's just two people agreeing, one's a buyer, one's a seller. You could look at this as one believes that the Patriots are going to win. One believes the Patriots are going to lose. No difference. It's just basically a bet between two people in the case of options. It's whether we believe the stock is going up or down, equal to Patriots winning or losing. And again, we can take either side. I can bet with, I think the Patriots are going to win or lose. And I do that depending on how I choose to do my strategy by being either a buyer or a seller. So let's just recap again everything we've learned today. We learned that there's two kinds of options, calls and puts. We learned about option characteristics. We learned that the option equals 100 shares of stock. They expire. Options expire on the third Friday in which the month the option is in. There are multiple timeframes, as in multiple months you can buy options in. There are multiple strike prices inside each month's option, what they call chain. There's something called the bid-ask spread, which is the pricing option, and we always want to buy or sell it at the mid-price, which is the most fair price. And of course we have to choose an up or down direction. Options have a directional component. We have to decide whether we believe a stock is going up or down. And finally, the most important thing of all is options can be bought or sold. We can be a buyer or a seller of any option. And again, the recap on direction. So if we believe the stock is going up, which I've put in green because most people consider going up as a good thing, we can buy a call or we can sell a put. Conversely, if we believe a stock is going down, we can buy a put or we can sell a call. Accomplishes the same goal. What I also want you to be aware of here is the different terminology, because these are all different terms meaning the same thing. So if in the future we talk about buying something or doing something as a debit spread, for example, or going long something, those all mean the same thing. Those all mean buy. Buy equals debit equals long on the sell side. If we're a seller, if you hear terms like credit or short, also means the same thing. If we're a seller, we can also be doing a credit spread on something, or we can be shorting something. Just wanted you to be familiar with these different terms. So here's what I want you to do. Obviously we covered a lot of material. Once again, that's just parrot fashion. This isn't about understanding yet. This is just about learning. So go back, review just a few times until it's second nature to you. To all of this stuff is in your head and you are comfortable with understanding it, and be comfortable looking at those different trade pages. I showed you 2 different trade pages, 2 different platforms. Not required to be used by you, but it's just easier to show you on those, and that's why I use them. Let's say we believe the stock price of Priceline is going up, and we're using Priceline because it's an expensive stock. If we believe Priceline stock is going up, here's our available investment choices. We can buy or sell stock, buy or sell calls, or buy or sell puts. So if we believe the stock price is going up, what should we do? Well, if you pick these 3 things you're learning, there are 3 ways we can make the investment. If we believe a stock price is going up, we can buy stock, we can buy a call option, or we can sell a put option. So why might we choose one strategy over the other? So here's Priceline, and here's the last price of pricing right here, $1,145.50, $1,145.50. So if we buy 1 share of stock, that's what it cost us, $1,145.50, $1,145.50. Obviously a very expensive stock, but let's say we want to buy 100 shares of stock. I think you see where this is going. 100 shares of stock is going to be 100 times that price, and it's going to be almost a $114,500, $115,000 for 100 shares of stock. Yeah, ouch. That's a lot of money. But what other choices do we have if believe the stock price is going up? Well, remember, we can also buy a call. So let's look at that. We're going to go here and we're going to buy a call. And for now, we'll see why later. But we're always going to buy the call that's directly below where the stock price is. So in this case, we see the stock prices of $1,145.50, and the closest call I can get to below that is $11.45. It's only 50 cents below. So that's what we're going to choose to do. And on this software, it's broken out a little differently. This software, that's the bid price. This is the ask price, and here's the mid price. And what do we like to buy or sell? Things that we like to buy or sell things at the mid price, right? We don't want to pay too much for something. So you can see the software defaults to the high price. We're not going to fall for that trick. We know the mid price is $47.40, and that's what we're going to pay. That's what we're willing to pay for it. So we're going to go over here to where the price is and forcibly put in $47.40. Now let's take a look at this option. So now we're buying one price line option. We're buying the 11.45 call price, remember, because it's directly below where the stock price is, and you see here we've typed in it's $47.40. But here's the important thing to remember, and this is where it comes into play. What have we learned about one option? What does one option equal? Well, we know now equals 100 shares. But up until now it hasn't meant much to us. But now it should, because what that means is, if $47.40 is the per price share, then the actual price of the option is going to be 100 times that. Because it's 100 shares. So one call option in Priceline is actually $4,740. $4,740. Very important to remember, every trade software is the same. Whatever number you see on the trade page is just the per share price. But remember, one option equals 100 shares. So we're always going to multiply that per share price by 100 to get the actual price of the option. So in this case, one call option in Priceline is actually $4,740. $4,740. And that gets us into leverage. So what is leverage? Well, we just saw that 100 shares of Priceline stock, which is obviously a really expensive stock, is going to cost us over $114,000, where one call option is going to cost us $4,740, and they both control 100 shares of stock. In the case of stock, for every dollar the stock price goes up, we're going to make $100. In the case of the option, for every dollar the option price goes up, we're going to make $100. How does that work? Pretty simple. In the case of stock, all we do is we have 100 shares of stock and we make $1 profit on each one. We're going to just multiply 100 shares times $1 and end up with $100 in profit. On the opposite side, exactly the same. If we have one option and that option value goes up $1, because options are leveraged, their times 100 equal 100 shares. Now multiply that $1 profit on our one option and we're going to end up with our profit on our option as well. Now it is important to note that these move at different speeds. Just because the stock price goes up $1 does not mean the option price goes up $1, but it goes up some portion of that. It's still leveraged and you're still making the money faster when the option goes up. So in this case, with stock being over $114,000 and this option will be in less than $5,000, why on earth would we ever buy a stock? In order to understand why I might want to buy stock over buying an option, I have to understand something called probability. Now if you already know what probability is, then just blow off these couple of slides, but if you don't, hopefully this simplified version of it'll give you at least a rough understanding of probability. And all probability is we're looking at a specific event and it's the chance of something happening. In the case of an event, there is always a 100% chance that something happens or it doesn't happen. I know it sounds a bit confusing, so let's take a look at a specific example. When I talk about probability, the chance of something happening or not happening, what do I actually mean? Let's take something simple like flipping a coin. Okay, when I flip this coin, what is the probability it's going to land on heads? So the coin landed on heads. What was the probability that was going to happen? Well, there's a 50% chance it was going to land on heads and a 50% chance that it wasn't, which means it lands on tails. Add those two together, chance of something happening and not happening, and they always have to equal 100%. But how do they actually work that out? So how do they actually Work out my odds of flipping heads. Well, in the case of flipping a coin right, there's only two things that can happen, heads or tails. But here's the important part. These are two equal chance outcomes. There's an equal chance it lands on heads and an equal chance it doesn't, which means it lands on tails. In order to figure out my chance of landing on heads, a specific event, now we're all looking at heads and tails. All I want to know is what is the probability of me flipping a coin and it lands on heads. What I do is I start with 100%, which I always do when working up probability, because that's the total of something happening or not happening. In this case, I only have two outcomes and there are equal outcomes. So I take my 100%, divide it by 2, and what I've come up with is there is a 50% chance that I flip a coin that lands on heads and the 50% chance it doesn't. And notice that 50 plus 50 equals my 100. These two numbers always have to equal 100 every time. So let's look at a different example. When it comes to unequal chance outcomes, in this case we're going to look at a car crash. Right. What are my odds of getting in a car crash this year? Well, there's 100% chance I do or don't get in a car crash this year. But these are not equal chance outcomes. And what I mean by that is it turns out that 1 in 16 people actually get in a car crash per year. So if I want to figure out what is my probability of getting in a car crash this year, how do I do that? Well, I start with 100%, which is always the total of something happening or not happening. In this case, it's a 1 in 16 chance. It's not 1 in 2, equal or unequal. So if I want to figure out my chance of getting in a car crash, I take my 100%, I divide it by my 1 in 16 chance. And what that works out to is I have a 6% chance of getting in a car crash this year and a 94% chance that I don't get in a car crash this year. And again, please notice 6 plus 94 equals 100. They always have to add up to 100. So hopefully that brief synopsis of probability makes sense. Watch this a few times if it didn't, just kind of get the raw idea of what we're trying to accomplish here as far as what probability means. In order to understand why I might want to buy stock over buying an option, I have to understand something called probability. Now, if you already know what probability is, then just blow off these couple of slides, but if you don't, hopefully this simplified version of it'll give you at least a rough understanding of probability. And all probability is we're looking at a specific event and it's the chance of something happening. In the case of an event, there is always a 100% chance that something happens or it doesn't happen. I know it sounds a bit confusing, so let's take a look at a specific example. When I talk about probability, the chance of something happening or not happening, what do I actually mean? Let's take something simple like flipping a coin. Okay, when I flip this coin, what is the probability it's going to land on heads? So the coin landed on heads. What was the probability that was going to happen? Well, there's a 50% chance it was going to land on heads and a 50% chance that it wasn't, which means it lands on tails. Add those two together, chance of something happening and not happening, and they always have to equal 100%. But how do they actually work that out? So how do they actually work out my odds of flipping heads? Well, in the case of flipping a coin right, there's only two things that can happen, heads or tails. But here's the important part. These are two equal chance outcomes. There's an equal chance it lands on heads and an equal chance it doesn't, which means it lands on tails. In order to figure out my chance of landing on heads, a specific event, now we're all looking at heads and tails. All I want to know is what is the probability of me flipping a coin and it lands on heads. What I do is I start with 100%, which I always do when working up probability, because that's the total of something happening or not happening. In This case, I only have two outcomes and they are equal outcomes. So I take my 100%, divide it by 2, and what I've come up with is there is a 50% chance that I flip a coin that lands on heads and the 50% chance it doesn't. And notice that 50 plus 50 equals my 100. These two numbers always have to equal 100 every time. So let's look at a different example. When it comes to unequal chance outcomes, in this case we're going to look at a car crash. Right. What are my odds of getting in a car crash this year? Well, there's 100% chance I do or don't get in a car crash this year. But these are not equal chance outcomes. And what I mean by that is it turns out that 1 in 16 people actually get in a car crash per year. So if I want to figure out what is my probability of getting in a car crash this year, how do I do that? Well, I start with 100%, which is always the total of something happening or not happening. In this case, it's a 1 in 16 chance. It's not 1 in 2, equal or unequal. So if I want to figure out my chance of getting in a car crash, I take my 100%, I divide it by my 1 in 16 chance. And what that works out to is I have a 6% chance of getting in a car crash this year and a 94% chance that I don't get in a car crash this year. And again, please notice 6 plus 94 equals 100. They always have to add up to 100. So hopefully that brief synopsis of probability makes sense. Watch this a few times if it didn't just kind of get the raw idea of what we're trying to accomplish here as far as what probability means. That we hopefully have at least a rough understanding of probability is. Let's see why it's so important when it comes to trading. So let's go back to our initial example of buying 100 shares of stock and spending $114,550 for it. And if you look down here, you see it says POP 50%. Now what does that mean? Well, POP stands for probability of profit, POP for short. And what does that mean? Well, here is our chance of making a profit on this trade. So in the case of buying stock, we have a 50% chance of making profit and a 50% chance of not making money or losing money. Well, after the few examples we went through with probability, that should ring a bell. What's 50-50 or so equal to? It's also equal to a coin flip. That's correct. Whenever we buy a stock, doesn't matter what stock we buy. Buying stock means we have a coin flip chance of making money. There's a 50% chance we make money in a trade and a 50% chance we lose money on the trade. Okay, so let's take a look at the option instead. So let's go back to this call option, back to the $11.45 we're going to pay them mid price, which is the $47.40. Now let's look at this instead. Here's our call option. Here's the price of that option, $4,740. But look at this now, POP has gone all the way down from 50% to 34%. Wow, that's a pretty massive move. So why is POP or a chance of making a profit so much worse when we're buying a call as opposed to buying stock? And that comes down to two reasons: break-even price and time. So let's start with break-even price. What is break-even price? Well, it's the stock price where both the buyer and the seller of the option break even. And what I mean by that is neither makes money on the trade and neither loses money on the trade, because if you remember, an option is just a contract between two parties, one side the buyer, one side the seller. There's only two parties for each option trade. So if one wins, one loses, and vice versa. Something to think of here is kind of a football bet. Buyer and seller is just two people making a bet on a football game. If I bet $20 my team is going to win. If my team wins, I win $20 because he loses $20. He actually gives me $20. The exact same number goes both ways. If I win 20, he has to lose 20. On the flip side, if I lose the game, I pay my friend $20, so I lose $20. He wins $20. But if the football game ends up being a tie, so nobody won or lost, what happens then? Well, we keep our money. Right. Nobody won and nobody lost. That is the break-even price for an option trade. It's basically a tie in the football game. It's that point where nobody makes money and nobody loses money. The buyer and the seller break even. So how do we define break-even price? How do we work it out? Well, it's really simple. All we do is we take the strike price and we add on the option cost. So what is that? Well, remember we were buying the 11.45 strike and we're paying $47.40 per share. So our break-even price is just those two numbers added together, 11.45 strike plus our $47.40 per share, gives us a break-even price of $1,192.40. Okay, let's go back to the trade page and look at this on our software. Again, we're looking at that price line option or buying the 11.45 call. It's $47.40 per share in this magical software. You'll see over here it nicely adds up the numbers for us. So 11.45 plus $47.40 gives us that break-even price we just worked out of $1,192.40. Now there's two things I wanted you to notice about this. One is that the stock price is currently $1,145.50. So our break-even price is well above our current stock price, right? It's $40+ above our stock price, and down here you'll see in small letters it says 47D. Now what is that? That's actually how many days till expiration, which we know now is the third Friday of the month in which this option is in. So there are 47 days until this option expires. So two things: break-even price is high and we have 47 days until this option expires. So if we write it down on paper, we will see why our odds of winning are so different. And that's because of two things. Again, the break-even price. Remember, the break-even price is here $1,192.40. When it comes to options, our break-even price is always going to be higher than our current stock price. In this case, it's significantly higher. Our stock price $1,145.50. You can see the stock has to go all the way up to $1,192.40 just for us to break even on this trade. And not only that, we have time working against us. The stock price has to move this much, $40+, and it has to move in a certain amount of time. In this case, we only have 47 days till this option expires. And that is why call options cost so much less than stock, because our chance of making profit is way lower. And why is that? Why does it go from 50 to 34? It's because our break-even price is higher than our stock price. Our stock has to move up, and it has to move up in a certain amount of time. We have time working against us, and we have break-even price working against us. Just a quick note I want you to look at here. This is not something you can work out yourself. POP is worked out by the computer. It works out your odds for you. That software which will show you down the line that works out your POP. This is not something you can do on your own, which is important to remember. So at first glance it might not look so bad. I mean 50% POP to 34% POP. Okay, but look at that. One investment was $114,000 plus one was less than $5,000. So maybe it's still worth it even though the POPs are so different. So to clarify this whole thing, we need to look at three different scenarios. We're going to look at the stock going down staying the same and the stock going up. So let's start with the stock going down, and let's say after 47 days. which is when this option expires it only goes down $1. So our stock price ends up here. $1,144.50. All we do is lose $1. What happens on our stock purchase? Well, remember we own 100 shares. We lost $1 per share. So all we do is we multiply them out. We take 100 shares times our profit or loss. In this case it's a loss. We end up on the stock losing $100. Okay, no big deal. Now let's look at call options and let's look at our primary rule about call options, which is if the stock price is less than the strike price at the expiration, we lose everything. So what happened in this case? Well, our stock price is $1,144.50. Our strike price is $11.45. Our stock price is less than our strike price, but only by 50 cents, right? Doesn't seem like a big deal. And it's 47 days later, so we lose everything, correct, because our stock price at expiration of 47 days is less than our strike price. Yes, we lose the entire amount of the option price we paid for, which is $4,740. $4,740. Ouch. Right. Well, we only lost $100 on our stock purchase. We lost almost $5,000 on our option purchase. Holy smokes. It doesn't look so good after all. Let's look at our second example. Let's say the stock price stays the same. Well, the stock price stays the same. Obviously, there's no profit or loss on the stock. Call option's slightly different. In order to work out what we made or lost on the call option, we have to figure out something called the net return. In order to do that, all we do is we take our profit, we subtract out our loss. We end up with the net return, which, because an option equals 100 shares, we're going to multiply by 100. So what does that look like? Well, let's start with strike price of $11.45. At the end of expiration, at the end of 47 days, the stock stays the same but is 50 cents above our strike price. So here's our profit, 50 cents per share. But remember what we pay for this thing. Well, we paid $47.40 per share. So we take our profits and subtract out our loss. We end up with a net loss of $46.90 per share. But options are equal 100 shares, so we times it by 100. So on our stock purchase we broke even. Our call option, we just lost $4,690. $4,690 because the stock went nowhere. Ouch again. So let's look at the stock going up. Let's say the stock goes up $46.90, and you'll see why I pick this number in a second, because all the way to $1,192.40. And this number should kind of look familiar to you now. Well, what happened to our stock purchase? Well, $46.90 per share times 100 shares means we just made $4,690. $4,690 in profit. Our call option, though, it says no profit or loss. Well, remember again what was our break-even price. Our break-even price was $1,192.40. Well, guess what? That's right where we are now. So the stock went up for $46.90 in 47 days, and we made no money. We didn't lose money, but we didn't make money. So the stock purchased earned us almost $4,700. The call option again earned us nothing. And this on a $46.90 move in the direction we wanted. Okay, no ouch. But you know what a huge bummer. So why on earth would anybody ever want to buy options when you see these numbers, right? Looks like it's impossible. Well, the reason people buy options is for something we like to call max profit. And here we say it's unlimited. So what does that mean? Well, unlimited just means the Stock goes from $1,145.50 to $10,000. We can make an unlimited amount of money. But for our purposes moving forward, I want you to now think of unlimited as undefined, because you're not going to make an infinite amount of money, right? The stock is going to stop somewhere. So unlimited amount of money as far as profit really means is undefined. We don't know where the stock can go. It's going to stop somewhere. We have an undefined profit. So the reason people buy options is because of this undefined profit. If I have a big win, if the stock goes from $1,145.50 to $10,000 in 47 days, I'm going to make a lot of money. So let's look at that big win. So, let's say the stock goes up a $100 in only 47 days. Okay, obviously a huge move. What do we make for the stock purchase? Well, 100 shares to $100 profit means you make $10,000. But here's the key thing with stocks versus options and that leverage we talked about. So the stock cost us over $140,000. So $10,000 profit on a $114,000 investment really only ends up being a 9% profit. Okay, not a bad profit for 47 days. Let's look at the call option now. The call option, when we work it out, earns us $5,300 and it only costs us $4,700 to buy it. So in the same 47 days, instead of a 9% profit, we make over a 100% profit. Yay, finally a winner. But look how hard it was to win. But this is the reason people buy options. They're looking for this big win, this big return on your capital. I'm investing a small amount with the potential to make a big amount. But remember, the pops are significantly different when you do that. You've already seen how hard it is to make money. You can make money, you can make a big win, but the odds are against you, or the probabilities, the chance of making a profit are against you. So I know that looking at all those numbers might seem a bit confusing, so what I've done here is basically encapsulate all those numbers slides into a visual slide. So here's what we're looking at here. All I'm doing is I'm comparing buying stock versus buying the option. And what we're doing is we're going from the stock being down slightly to up big. And here's the differences. Down $1, not moving up $20, up $46.90, up $100, and we're comparing the profit or loss for stock versus the option. And really all I want you to notice from this slide is if I buy stock in 3 out of 5 scenarios, I make money. If I buy an option in 3 out of 5 scenarios, I lose money. That's the biggest takeaway I want to get from this. Also, what I want you to notice is the break-even prices. As you can see here, the break-even price for stock is here at this number of only $1,145.50. But in order to get to the break-even price for the option, we have to go way up here. We have to go all the way up by $46.90 just to get to the same break-even price as well. So 3 out of 5 scenarios lose for buying options, and our break-even price is way above our break-even price for buying stock. Those are the 2 biggest takeaways from this slide. So let's do a quick recap on buying call options. What have we learned? We've learned that if we buy a call option and the stock goes down, we lose money. If the stock stays the same, we lose money. If the stock goes up a small or even a medium amount, we generally lose money. Only when the stocks are up big are we guaranteed of being a winner. And that's exactly why call options cost so much less than stock, is because our probability of profit, our chance of making money, is so much less. In this case, it goes down from 50% for buying stock down to 34% for buying this option. And why are those numbers so drastic? Because of 2 reasons: break-even price and time. They're both working against us. Break-even price if you remember, is always going to be higher than the current stock price. In this particular example, it's $46.90 higher. So the stock has to go up $46.90 just to get to our break-even price. So we don't lose money. Not only that, but in this case, in any case, option time is working against us. Not only that the stock price has to move, but it has to move in a certain amount of time. In this case, there was 47 days in this option. So after 47 days, this option will expire if the stock hasn't moved up at least $46.90. We're going to lose money. So break-even price works against us and time works against us. When we're buying an option,